VIX expiration tomorrow, February options expiration tomorrow. And because it's the monthly OPEX, it means that Imran and I are going to get together and debate the impacts of options expirations. Imran, how are you doing?
I'm good. Good to catch up, man, as always.
Yeah, it's great to catch up. And most importantly, what's that?
Got my Options Insight hoodie on, especially.
Oh, that's good branding right there, man. I was just thinking it's Valentine's Day, and I did not get you a card or anything like that. I feel like I owe you something. So there's a little heart emoji for you. So, we've had a lot of volatility in the market on a daily basis. And ultimately what that has brought out is a lot of nothing in over kind of like a day-to-day or week-to-week view. And I think what you and I were just talking about is kind of what's the impact of VIX expiration, and, volatility is just kind of front and center in the markets right now. And so, I guess let's just get a state of the union from you. And I've been watching your Twitter feed quite a bit, and so I have a good idea. But tell the people what they want to hear. What's your sort of opinion on the way things have been moving the last week or two?
So obviously there's a bit of nervousness building up last week. We had a lot of protection buying come in. People got a bit spooked that the jobs number was so big. Are we going to see a hot CPI? Terminal rates were pushing up to new highs. So that got the market a bit nervous. So all those February options kind of caught a bit of a bid last week. So you had fixed strike volume. February was up like 4 vols last week, which is pretty punchy on a week when the market's down like 1%, 2%, something like that. We haven't really seen that type of vol bid on weakness in the market for months, right? Because generally everyone was very underweight. They didn't really need to reach for puts. If anything, they needed to reach for calls. Mm-hmm. That turned on its head because January sucked a lot of players back into the market, right? Who are underweight, couldn't really afford to not participate in upside if we were going to get that for the first quarter. So they got forced back into the market. And then when this kind of mood sort of turned, we might see higher for longer on rates, and rather than dumping all the stuff that they just bought, they've then come in and bought protection. So the skew went bid, the vol went bid, and it was just a matter of time once the CPI came out for that stuff to start to evaporate and come back down. And we're in the process of seeing that now. And I suspect that's going to continue into Friday.
Yeah, I'm with you. I think particularly after the performance that we've had in January, there's so much upside. And, we had a couple of days of record call volumes into the start of January. And kind of to your point earlier about the idea that some people started to demand some hedges on the screen right here. I think if you look at this little point right here was where one of those big VIX call positions went off, right? I think somebody bought 300,000 March VIX calls. And then obviously there was another June buyer, I think a couple of days later. And then there was the icon trade at 40.50 this week. And so I think it was clear that there's been this idea of like, we're a little bit more worried about the left tail into the CPI and right here versus the right tail. But some of that may just be performance anxiety in a way, right? In the way that, look, the market's up so much, I actually have some gains to protect here. I maybe have some equity positions actually on that I want to hedge. Whereas I think one can argue towards at least the tail end of last year, it was still like, hey, I just want to get out of a lot of this stuff, arguably. And so I didn't really have a whole lot of stuff to hedge. And so, why should vol pick up on that? As we, when you look at, and one of the things I'm curious to get your feedback on this, when you look at the CPI reading today, I mean, I think the straddle was priced at like $60 roughly, something like a 36 implied vol, if I remember correctly from this morning. And it seems like the prices of those, the implied volatility premium on these events is really starting to come down. Do you think that is a reflection of people not being as concerned about the print, or do you think, the way that I would describe it is that everybody got burned over the summer when there was a couple of big multi-standard deviation prints? And sorry, I'm just bringing up the note here to see what the CPI was. Yes, it was 67 when the implied vol 36, but the implied vol seems to be coming down with these events. And do you think that's a reflection of people caring less about the event, or do you think it's more of a reflection of the fact that, hey, like I got burned very badly over the summer with some multi-standard deviation CPI prints, and so I really need to hedge these things? Or do you think people are not as concerned with whatever the CPI print may say? And one of the reasons I ask is because that jobs print was pretty nasty in terms of missing expectations, right, last week, and the market didn't really do a whole lot.
Yeah, that's a good question. I mean, I do agree that the importance of the prints is falling, right? Because in general, the market's got its head around the idea that there's a disinflationary trend building. And so whilst we might get 10 bips, 20 bips higher month on month inflation print than expected 1 month, the idea is that it's quite entrenched now that we are getting disinflation. Okay. So that is the thing back end of last year, you know, people thought inflation could just keep going higher and higher and higher, right? They didn't know when it was going to peak. So you had, you know, it was that sudden change that, oh, we've gone from fearing high inflation to suddenly look how much it's disappointing. And there was a change in expectations there that led to those sharp squeezes that we had. But now everyone's kind of quite comfortable with that trend. So then it's like the jobs market. So then everyone was thinking the jobs market should start to slow as well. And it hasn't yet. But it's been stubborn for a while, the jobs market. So again, it's not so wildly different from market expectations because one print isn't everything, basically, right? It's really the trend of the prints over multiple months that we're looking for. And you know, it does seem as well that with the zero DTE crowd piling in on options, there's this natural kind of mean reversion that goes on intraday. So while you might get a print that then makes the market move, people who've bought options to play such move then unwind them after the move, and then it mean reverts again. So you're kind of not getting as much close to close volatility as you're getting intraday volatility, which means the price of the straddle doesn't necessarily need to be as high because you get that mean reversion. And I think that zero DTE flow is exacerbating some of that.
That's a fantastic point. A couple of people are mentioning that, like Paul in the chat here, I guess that, and we can actually see that kind of play out in real time. And I was going to look at the VIX term structure, or excuse me, SPX term structure here, but the flow today, the zero DT flow in particular in the S&P was so fascinating. It highlights exactly what you're talking about. And we've been doing a little bit of a longer term study in the kind of TLDR study of the zero DT stuff, is that it seems to actually on net be suppressing volatility in the S&P. I think obviously the Carvana calls is a different story or whatever, but what you can see here in white is the S&P 500 price, and then in purple is all options flow, the deltas, right? So as we move up on this chart, the purple line goes up. That's positive delta, so that's driven by call buying and put selling, and then down obviously is put buyers and call sellers. And so what you can see is with teal being zero DT, but what you can see is that as the market opens at 4,100, there's positive deltas coming to the market. And I think a lot of that is actually put covering or volatility selling off of the print. But then when we get to 4,150, all of a sudden those deltas drop. And you can see the deltas drop sharply before. And what that is call selling. And so I can actually break that out here. And I'm doing this to make you look good, Imran, because it highlights your point almost exactly that, you know, you can see very clearly here as the market hits a high, we get sharp call selling. Put buyers come back in, and then as the market hits the low, what happens is the reverse flow comes in, right? If I sold the zero DT call at 4,150 and we're at 4,100, that zero DT call is worth nothing anymore. I'm going to cover that position, right? Or I may sell puts at 4,100 because I think the market may turn and go back up. And so you can see these flows really come into the market here and kind of back up. I'll try to make it look a little bit more simple again, back to the original state here. But you can see these flows come in and really interact with the market. And again, I think you're right. And that is a massive volatility kind of, it's like one of those finger traps, right? Where the harder you try to move, the more options flow comes in, the more things kind of get really locked in. And as you see here, we're tricking a little bit lower on some of these deltas as the market has shifted back up to the 4120 to 4130 area. So to your point again, the volatility is high, but it is really getting suppressed, I think, by the zero DT stuff. And then if we look at the volatility term structure here, you know, volatility in the short term seems to be a little bit elevated because we have, you know, a couple more data prints coming out tomorrow. And I just don't know what the data print tomorrow is going to tell us that's going to change everyone's narrative dramatically at this point.
The retail sales number tomorrow, right? That's what people are looking at.
Yeah, and I think there's like a PPI and, you know, all these things that didn't really matter before. It's like every data point now is the most important data point that's ever existed. And ultimately, we were just talking about this on the Ninja Trader kind of podcast we were just doing before this, is that ultimately, when you look at all this, this was the December CPI print right here, right? That everyone was it was like the biggest vol ever associated with like a CPI print or any data print ever, right? And here we are, like, if you look at the actual candlestick of this, we popped after that print came out at 8:30 in the morning, and we're right at that same level here 2 months later, where people now don't care as much about CPI. And so it's just sort of like, what is the information that actually matters? I don't think it's the data print that comes out tomorrow or the next day, right? It's going to be something that's
noise.
a little more.
This is all noise, basically. Yeah,
it's noise, right?
Yeah,
right. And the implied vol has been very rich on that, and so I think the natural thing has been like, sell the straddle, sell the straddle, sell the straddle. And today it's like 1.5% move, which wasn't as clearly obvious that you maybe want to take a swing at selling that thing. But here we are, we're only down 17 handles on the day, and short that straddle would have paid fairly well. And I haven't looked at what the prices are for options tomorrow or Friday, but again, the volatility is so elevated for these prints that historically just have not mattered. One wonders if the market should care that much. So I'm going to pivot the screen a little bit here in terms of what's going to happen now over the next few days. I think we've been talking about the situation into this, and apologies, there's so many lines on your screen here. We'll clean that up. But this is sort of the state of affairs, right? We have, in our view, we have this call wall above at 4,200. That's probably not going to shift before Friday now, based on the price action today. This 4,100 bar down below us is a big one. And then we have the 4,000 level, which is going to be this important level, I think, probably for the remainder of the year. And we may just end up kind of cycling around that. That's another idea. This is 4,000 right here. And you can see that really since May of last year, we've really just rotated around that. And so a few of the things I want to get your opinion on. One, in the short term, what do you see happening in the next couple of days? VIX expiration tomorrow, pretty decent sized Feb OPEX. But over the longer term, I'm warming up to this idea of kind of a lost year in terms of ultimately we don't go anywhere. And so the way do you express that is basically like, do you just sell the 4,000 straddle for December and call it a year? But let's get the short-term view from you first. VIX tomorrow. Yeah, there's a couple of data points. Feb OPEX. Are you in the camp that this opens up kind of a window of weakness into next week, or what's your sort of short-term view?
Yeah, I mean, I think we're probably supported until OPEX. So I think the VIX flows have been very call dominated, so that's all expiring tomorrow. So if you look at the open interest on the VIX, you've got a lot more open interest from sort of where we are now, 19 up to 23, than you've got below 19, basically, right? And generally, clients are buyers of VIX calls. On the put side, it varies. Sometimes they sell, sometimes they buy. But, I think the fact that calls were bought in quite big size and the VIX is now dropping post the number means that a lot of these VIX futures that dealers have had to own against those calls, as those calls are evaporating, they need to dump those VIX futures. And that's kind of what we're seeing happening. So wouldn't be surprised if we get a continuation of that into the print. So VIX kind of stays heavy. Just in general, I've been saying pretty much since the turn of the year, I wouldn't be surprised to see VIX. I think last time we spoke for OPEX in Jan, I was saying I'm thinking VIX goes sub 18 at some point.
Yeah.
It did pop its head below 18 briefly, but then bounced. I'm still expecting to see a 16 handle on the VIX at some point in Q1, right? So that's my base case for vol, is that we go lower. If you talk about the move index quite a lot, rates vol is coming down. Yep. There's no two ways about it. Certainly in the long end. The short end's been moving quite a lot. So the curve's been inverting even deeper recently. So those of you who are brave enough to have the flattener on in the yield curve have done well. But in general, looking at TLT's been bouncing around, between 102 and 107 for a while, and vol's coming lower, right? So I think that is what's the trend, certainly for the next 2 months, is probably for vol to continue to go lower. We've got net liquidity turning positive. We've got Asian central banks still going guns blazing on printing. We've got the TGA drain and the T-bill issuance that people talk about in the US that's going to be a positive for net liquidity. So in the near term, I think that's probably the path of least resistance.
Yeah, I've warmed up a lot to your sort of agreeing with you on this idea, as I was actually going to bring up the E-mini liquidity here is one of the metrics that we've been looking at quite a bit. And sorry, I got to flip it to book depth here. And so the idea that there's easing out here and liquidity is coming to the market, I mean, forgetting the more complicated measures of the TGA and things like that, you can see here is depth of book in the futures market. And as you could see, at the end of 2021, there was a lot of liquidity, right? And you associate higher levels of liquidity with lower volatility. And you can see how that E-mini liquidity just evaporated right into that March timeframe, stuck that way into May again, and now it seems to be rebasing or increasing here, right? And I think that's a good sign for market volatility overall. And as market volatility comes down, that says that liquidity is arguably increasing, and that should be, and that's actually one of the key things that we wrote in our note this morning was like, hey, that should improve. That should be taken through a bullish lens or context. And so I really agree with you on these points. I think the idea that we're going to get a VIX sub 18 kind of new low over the next quarter, particularly into March, I think that's actually a reasonable guess at this point. Because even though like today, right, the S&P is lower, you can see the VIX here is off, quite a bit, and realized vol is going to continue to get, I think, pressured overall. And this feeds into sort of this longer term view that I actually think that, this year, I think we're so preconditioned to getting 20%, rallies over the year, right? Or these just giant moves in the market writ large, like from a passive investing standpoint, you just put your money in, you're going to get a 20% return off of, Fed fuel. It's going to be more of a stock picker's market this year, but volatility overall should come down. And, you're saying VIX 16, well, VIX is getting hit pretty hard today, even though, again, the market is down, which is just, it's an interesting,
if we get up to your call wall, by the end of the week, I wouldn't be surprised to see the 16 handle by Friday, to be honest.
Yeah. And again, these movements, as we just showed, this is all zero DTE stuff. The people bought this dip, the market ripped, they sell tons of calls, the market comes down, then they sell tons of puts, and up we go again. And these are these positions, as you were mentioning before, where this is the Vanna trade, right? As we march through expiration, the CPI print takes a ton of vol out of all these positions, right? The icon trade and any other puts that were on. And so, vol just gets sucked out of the market. And that has to be seen as a tailwind for equities over the short term. And I think ultimately that translates to over the long term as well.
Yeah, I mean, another thing, right? Crypto doesn't care. It's up like 4% today, Ethereum, 2% Bitcoin. Doesn't care that terminal rates are going higher. Obviously, it's come down a little bit last week on the back of SEC cracking down on Kraken and stuff like that. But it's just that, to me, is a little telltale sign. Crypto's trading well in the face of a stronger dollar and higher terminal rates. I think things might be in, risk on mode.
Yeah, I was listening to a great podcast. I don't know if you listened to Forward Guidance. There was a gentleman talking.
Yeah, I love Jack. Yeah.
The most recent guest he had, his name escapes me, but he was talking about Bitcoin
cross-border capital.
Yes, exactly. He had a great comment on Bitcoin around there being some great correlations around basically, Bitcoin being this. He had data that was backing this idea that crypto is sort of this all clear metric, right? And if Bitcoin and some of the crypto start to rally, there's this argument made that there's a good amount of liquidity and some relative safety. And I know that's something that you harp on. And so that gentleman was backing that idea as well. He had a couple of really interesting insights on the macro sort of in regards to some of this TGA stuff and rates and all that. So I recommend everyone.
He's a lot smarter than I am in terms of liquidity. I mean, he's like one of the biggest experts on that stuff. So yeah, he's definitely worth a listen.
Yeah, well, one of the things that he said was most insightful, and I'm going to get over my skis quickly on this, so I'll just give a quick sum, was that the 2-year, 10-year inversion, which is so massive right now, is more of a function of the demand for collateral, with the 10-year being the most pristine collateral you can get, right? And so that's really what is causing the 2-year, 10-year
right.
inversion here, which a lot of people are saying that, hey, this should be Armageddon, right? This is that spread. And historically, this is associated with very nasty recessions and very poor markets. But he's saying that this is actually just a function of market mechanics where there's this demand for collateral. So again, I don't want to get too over my skis on this, but definitely kind of go and check that one out. To this idea of a stock picker's market, I wanted to get your opinion on this. Is a little bit outside of the options market, but still I think it's pressing and important because we're going to get these spurts of call mania, and I want to talk on the record call things for a bit. But if you look at this is the S&P value index, right? So this is their ETF, value ETF, and it's at all-time highs right now, which is pretty remarkable. And then when you look at the Qs, obviously we're nowhere near all-time highs. And so there are all these signs that essentially point to, and we wrote a big piece about the VIX up, market up thing, and how the top components of the S&P 500 were all the top tech names, right? And now they're switching. So it's like Berkshire Hathaway and JP Morgan and UNH. These are the top stocks now, right? There's been this rotation. You're not going to get this, like, correlation seems to be breaking down as the market is shifting up, and you're getting an equity rotation as opposed to a wholesale sell-off. And the value index, which is in white here, again, it's at all-time highs. And the NASDAQ is, well off its recent lows, but I don't think it should ever get to these. I shouldn't say ever, but you're going to be hard pressed to make a solid case, to me at least, that the NASDAQ should get up to this level without some big old stimmy. But this speaks to kind of market rotation and the internals of the market being pretty healthy, actually. And the movements of markets, being more of a stock picker's environment now than sort of a passive, indexing vehicle, if that makes sense. Do you have any kind of views or thoughts on that? I mean, do you look at these internals in the same way? I know you look at the global macro landscape.
Yeah, so this is last time we spoke, I think I flagged a trade, right? That was long tech, short diamonds, right? Long Q, short diamonds.
Yeah, that's right.
Because you remember, right? And I didn't put the bloody trade on. I wish I did. It was an amazing trade, but hopefully some of my subs did. But anyway, what I was going to say, so I thought the tech was a bit sort of, under-owned. So I thought if we got a rally, tech needed a catch-up, and we had the big cap earnings coming out as well, and that's kind of what happened, right? Dow had massively outperformed Qs from October last year lows, and the NASDAQ was, getting killed, and it was like, there's a catch-up trade here, right? So it outperformed by however much it outperformed in order. But now that it's done that, I kind of agree. Yeah, I don't think it's a case that tech's necessarily going to outperform again, right? Like there's some big fundamental shifts now, right? In terms of a higher interest rate regime, a higher inflation backdrop for the longer term. Even if inflation is coming back down, people are like, how far does it come back down? How fast does it come back down? So that, this rotation away from mega cap US tech, and it's US, right? One of the reasons why these tech names did so well, because they were the names to buy in the US market, right? They were the big caps in the US. Whereas now there's a lot more focus on EM, on international equities, where there's value, right? China's value, Europe's value, right? They are the value, cheaper valuation type companies. And so there is money being allocated into those and away from the US. And also if the dollar's topped as well, which a lot of people think the dollar's topped, then they don't necessarily want to just be parked out in US mega cap tech as well, because the dollar's going to weaken. So all these factors are playing their part. And so, I don't think it's a no-brainer to own, NASDAQ anymore. If anything, probably sell rallies in NASDAQ at some point. I do think the squeeze could go on a little bit longer, just in general, because I think liquidity, as we've discussed, and, in Q1, generally, I think the shit doesn't hit the fan necessarily in Q1. But as we approach summer, then, I wouldn't really want to be long loads of tech.
Yeah, and those are a lot of those tech stock, obviously, are they were the beneficiaries of all the free money, right? That was coming out in cheap rates and things like that. And another podcast, the All In podcast, actually this last Friday got into a lot of this. And so what's interesting about that is that, the higher CPI prints or whatever, it could hit a lot of these names asymmetrically, where I think over the past 2 years at least, we've all been we've all benefited from just buying crap and it goes up, right? And now I think it'll take a little bit more, nuance. IR Impossible says the cross-border capital you mentioned, but I think this is the fellow's name. Michael Howell is the,
Yeah, that's right.
yeah, I think he's on Twitter as well. So shout out, as I say, to him. Chase makes a comment that the 10 years up 35 bips in 2 weeks and says there's no bond volatility. Well, bond volatility is all relative. What is a lot of volatility? If you look at where the move index has been, or bond volatility has been, I think the trend there is certainly lower. So, maybe comment that. And then Paul mentions, look at the RSP, which I think is the equal weighted S&P versus the S&P itself. I actually haven't looked at that chart in a while, so let's take a quick look at that. Thank you, Paul, for that heads up. And that's one of the kind of nicest things about investing in the S&P is like you naturally get that rotation, right? The top stocks in the S&P shift act normally as Tesla runs out of favor and UNH grows in market cap. Well, you own more of that over time. And so that is one of the nice things about owning the S&P versus the diamonds or the Qs, is because you're naturally getting some of that shift in weighting. But yeah, as you can see here, there's been a pretty stark difference in the equally weighted S&P, which I think is RSP versus the S&P itself. One of the other things I think that we talked on, and I got to switch the screens again here, was the performance of emerging markets. And I have all the indices here. I've been just kind of beside myself at how well some of these things are doing. Sorry, I'm scrolling through my giant list here. But these are just a bunch of the different S&P or iShares, emerging market indices. And if you just look at them over the past year, this one's Chile, all-time highs. I think Mexico's at all-time highs. There's Australia, a lot of the Canada, Italy, Europe as a whole is actually doing very well here, right? Which is fairly shocking considering, I think, the environment that a lot of us picture. And, Imran, you obviously sit in London here, so things must be going very well based on your market performance.
No, I mean, it just shows you how bad expectations were, right? Like if you look at the City Economic Surprise Indices, I mean, the European ones were just beating the crap out of the US ones for a while. So it was just that, expected economic data out of Europe was so bad because everyone was so fearful of the energy crisis, and things just didn't turn out that bad, right? So
this is Italy. This is like a multi-decade high here for the ETF. It's really pretty amazing.
Yeah. Yeah, and when people are underweight as well, there was a lot of money that allocated back into Europe, right? At the back end, like from November, that Europe outperformed the US by like 15%, right? Because no one owned it. So I think that's been addressed to some extent now, right? Like fund manager surveys kind of show that people have allocated more capital back towards Europe. So I'm not as optimistic on European markets now, given that they had that repricing early in the year.
Yeah, and it's hard to buy back into these things at 5-year highs, because I think as good as it's with all the stimulus and easing that is coming to the market. And I understand some of that stimulus is starting to come back vis-a-vis China and the like. It's just hard to believe that we should earn those same kind of multiples. But granted, I'm again over my skis and sort of talking about valuations. It's been amazing to look at these charts and think like, hey, these international markets have done so well. Someone is mentioning here about the 39.50 icon trade for March today. I've been on calls all day, so I have not picked up on that myself. Do you have any comments on that one, Imran?
I didn't see it either. I haven't been watching it either. But so he looks like he's reloading then, right? Because these Feb ones are kind of dead money, I guess.
Yeah, and that guy's got a couple $1 billion in his fund, right? And so even though these are big S&P trades, I think they're more hedges because he's got some trades, some dollars to lock in, as opposed to sort of expressing a view that maybe the market's going to go down. And this is kind of the view that, hey, people have regrossed some here in the start of the year, and so they have some things to hedge. And so, yeah, it's a big trade, but I don't know that it's Icon sitting there saying, hey, I think the market's going to go down. I think with Icon in general, what he'll do is he'll come on, and once he's really short, if he says, hey, the market should go down, then he's positioned to the short side, because he's kind of famous for doing that, kind of talking his book.
What do you make of Tesla?
What was clear about Tesla And I was a little early on our call that the thing could rally. I said, don't be short at 125, and it went down to 105. But, it's had this incredible rally. I think that this was so emotional for people, and people have, Tesla was the most invincible stock and had this retail tribe that put meme mania, the apes to shame, right? For most of the last, really from 2019 on. And all of a sudden, like, he got involved with Twitter, and it just made people so emotional, And I think that what I bring up from that is that this whole last kind of final move in December, I think, was a lot of just, tax loss selling and just these emotions that the company should go out of business because of Twitter, and people don't like the politics on Twitter and whatever. And it's sort of just, it detached from short-term reality, and is really what my view is. The stock, is it overvalued? I don't really have a great consensus. I think it's much more moderately valued now, obviously, than it was in previous years. And so, it's hard to have a great opinion here. One of the interesting things is that when you look at the options positioning, and I could bring that up quickly here, people were constantly putting call positions in at higher prices as we were rallying from kind of 100 up to 200. But that flow has really kind of dried up a little bit. And what I show you is, if you just kind of look at the Tesla call wall, what you can see is that it's at 200. And if you look at it over the last, several days, it's come back in and around this expiration. And so what I'm sort of reading is that the chase that was on is over, and we need a new narrative to continue this thing materially rallying in the same way, right? Meme mania was definitely part of this, and the short cover and all that, but this goes really across all stocks. There was this huge chase, and that chase has really dried up, writ large across the board. It doesn't mean that we can't continue to sort of move higher in a lot of names, but that kind of expecting that 15 to 20% movement in a month is, those are rare occasions, or should be rare occasions. And I don't see that same positioning building. What's your sort of take here? Are you going to buy this thing, or what you going to do?
No. If anything, I'd fade it. I think the meme stocks and the ARC names have rallied a bit too much. So I think, we've seen terminal rates are at like 530 now, right? So whilst a lot of these stocks had an uplift because everyone was short them, and they all started cost cutting like mad, and they got rewarded for cost cutting, basically, right? So they had a re-rating back up. I mean, ARC went from 29 to 43 or something.
ARC is the new NASDAQ. If you haven't heard.
In a straight line, that thing went from 29 to 43. It's back to around $40 now. I'm tempted to get on the short side on ARC again. I haven't done it yet. I probably want to wait until I'm just generally more bearish. But I think to play the down leg in some sort of put spread collar structure, where you buy a put spread on ARC and you sell calls on ARC, so you're net short vol and short the market, I think that would be quite a good setup at some point, right? Because where are you happy to be short ARC? 50, right? Maybe you sell the 50 calls out to June, and you see what put spread you can buy for those, or something like that, right?
Yeah. I think of all the uncertainty out there, whether you're in the higher for longer camp or not, unless we're cutting, then there's no real benefit for ARC to rise or rally here. And so, I'm more or less with you on that. And this thing has unwound its entire bubble. And I think, again, people are preconditioned to think that this is ever going to happen again. And this is the biggest liquidity injection. And, the Fed and everybody was globally, unified to say, let's pump assets, right? Like, here's free money. And we're so far away from that environment now. It doesn't mean that everything has to crash, but it's just like people think that we're going to get these style of movements. And I think fading those movements when you see them, because we're bound to get some more of these kind of like call mania moves that don't make sense. I think almost just sitting and waiting to sell into those is maybe one of the more interesting ideas here. Sorry, there's a couple comments here. Rob thinks that Tesla has the brightest future of any company out there. So I guess.
It may well do, right? Long term, right? I think people, but those arguments are quite long-term arguments, right?
Yeah.
So, people say that they're just miles ahead of any other EV company. And, with this AI revolution that's happening, they're going to massively benefit from that as well. So I don't necessarily disagree that in terms of innovation, they are miles ahead of everyone. Like, people are saying they're like Apple 20 years ago when they were still innovating, basically, right? And look what happened to Apple. They became the biggest company in the world. So I get the arguments. I just don't think they happen tomorrow, right?
Right.
So I just think between now and sort of June, September this year, we've still got to navigate some more downside in markets, probably. And so I think any rally in the next month or two probably gives you an entry point to sell for that dip down that I think still comes.
Yeah, I think I by and large am in agreement with you there that there are some of these stocks that just move so much that could serve for some consolidation and in a lot of ways, I think that given given the fuel like short dated call options and all these kinds of things, I think that when you have stocks that rally off of that kind of flow, it generally creates a less sustainable base, meaning that it's easier for the stocks to kind of mean revert that benefited from the zero DT and short dated options flow and the like. And again, anytime you see these levels move down, or key gamma strikes and the delta strikes and things move down, that generally suggests that option traders are not positioning for more strength. They're doing the opposite, right? They're looking for downside. Because if you think that the Tesla's bound to go higher, you're going to see bigger call positions above, and you'll see like these call walls shift up, right? You'll see all these positions move up. And then obviously there's this other interplay of options expiration. And what our data shows is that the stocks that perform the strongest, and this actually goes for the S&P as well, if there's a bull rally into OPEX, we tend to get consolidation in the week after. And so I think that is likely going to be true for a lot of these stocks that have rallied so strongly that we may get a little bit of consolidation to start next week. And I would view that as consolidation and not maybe the start of a longer term a bearish move.
Mm-hmm.
So Imran, I know you had your presentation prepared here, or you sent it over to us. There's a lot of great information in there. Is there anything in particular in that you want to check out?
No, I mean, I just thought I'd send it over just so people can have a look at what type of stuff we do if they don't already know. So I write a macro options daily note where we look at our cross asset vol dashboard. It covers a bunch of asset classes: equities, commodities, FX, bonds, and some sectors, equity sectors. We screen for what spot is doing, what vol is doing, what realized is doing, and what skew is doing, to try and gather some insights into what the vol market is telling us, if anything. And then I look at some topical stuff like what's happening, this week that matters, like the CPI, for example. We've got a fixed strike volatility monitor where I can see what's going on in fixed strike vol, which is a little bit different sometimes to what's going on in absolute floating strike vol, right? So the VIX is like a floating strike because the VIX is just a vol number that goes up and down with the market. But in reality, options traders trade fixed strikes, right? When you buy the 4,000 strike put, it remains the 4,000 strike put. And the implied vol on that particular option moves up and down, but it's still the 4,000 strike option. So it makes sense to have a monitor looking at the fixed strike vol surface, because that gives you more information about dealer positioning and how dealers are experiencing volatility moves outside of just that floating VIX number, right? Which doesn't always tell you the full story, right? So we keep an eye on that to see what it's telling us. And then we've got the dashboard there in gold, if you want to scroll down to the last page. That one there. So this is our dashboard that we have for every asset. We screen, we bring everything into one place. We monitor how we have something called volatility carry, which is just a calculation we do on realized versus implied, but we use our own sort of numbers, like what we think are relevant. We look at the term structure. We look at what trade is jumping out of the page from a pure mean reversion perspective. So right now, gold I've stuck in there because gold is on my radar to buy the dip in gold, basically, right? We had a really decent rally in gold. We're in a corrective phase right now in gold. I think that correction has some legs still, maybe 2 to 3% lower, and that will be a nice entry point to get into gold for a longer term position. So that's what I'm doing. That's what I'm basically looking at. So waiting for, I do own some puts right now in gold to March. I'll be looking to close those out 2 to 3% lower, and I'll probably flip long calls or call spreads. basically. Yeah. So these are the type of insights we give and the type of trade ideas we try to generate.
That's a beautiful dashboard, and optionsinsight.com is where you can options_insight, right?
Options_insight is my Twitter.
Is your Twitter handle, yeah.
And options-insight.com is my website.
Hyphen and underscore. Okay.
Yeah.
So as we sort of approach the top of the hour here, the questions seem to be asking us back. We're circling back to these next OPEX things. What is your view over the next week? As I look, we have Chase here and some other guys asking, what do you think is going to happen out of the next week or two, gun to head with the market? I know you and I sort of touched on that, but let's just give a quick overview before we end up here. What you're looking for the next couple of days?
I think we probably rally or kind of stay supported into OPEX. We then may have a little window of weakness, but I think that would probably still be a dip to buy. I think the liquidity, the net liquidity, is going to keep a bit under markets, at least until March FOMC, when things might come to a head. But I actually suspect even March FOMC won't be the big one that moves markets lower. If we're going to get an FOMC catalyst to take markets down, I think we're going to be waiting till May or June for that to happen, where there might be a material discrepancy between what the Fed's projections are and what the market is pricing, and then the market will have to then reprice and reflect that change. But I'm not sure that's going to happen as soon as March.
Yeah, and I think that if we push up to 4,200 today, that will give a little more impetus for some what I would call OPEX consolidation. I don't think that we're going to get a big vol spike just for the sake of vol spiking here over the really through Feb OPEX. I don't know what the catalyst is. I think that by and large, what people are going to be looking to do now is buy the dip in various stocks, unless we get some really bad data. And the reaction of the markets to this is the VIX term structure. The reaction of the markets to these recent data points seems to just be volatility kind of getting sucked out. And a lot of stocks have had some pretty good rallies here over January, particularly like the tech stocks and the like. But so maybe we get some consolidation, but I think I'm overall more with you in the camp that what is the reason for a significant sell-off, right? Particularly one that breaks a 4,000 level, which is just this giant options level. That's really important to the market. So on a daily basis too, we continue to see 0DT really suppress volatility, and as volatility trends lower, you mentioned VIX 16 before. I do think we're going to press down, and I can get on board with this idea that we see like a VIX 16 handle at some point here in Q1, which has another more or less 6 weeks. So while we might get a little bit of OPEX consolidation next week, I just don't see the reason for markets to drop significantly lower without a catalyst. And as you mentioned, there's not necessarily a near-term catalyst. When I say catalyst, like an FOMC update or a Powell update that says, hey, look, we really got to get much more hawkish here. You guys just don't understand what I'm trying to say to you. I don't know that a jobs number will really matter at this point, or a retail sales number will really matter at this point. We really need something to change the narrative here. I am warming to this idea of maybe just selling a December straddle and going to sleep for the rest of the year.
Yeah, I mean, I personally wouldn't trade it that way. I would, because I think there'll still be enough choppiness to trade. So let's say that's what you believe, right? You think selling call is the trade. I'd probably prefer to just, on rallies, I'll sell debt calls, and on sell-offs, I'll sell debt puts, and I'll trade around it like that. So that way you can kind of scalp that and trade those swings, basically.
Yep,
right?
Exactly.
We go nowhere, but I think you'll make more money doing it that way than just slam a straddle and kind of wait for it to kind of bleed out. Do you know what I mean?
I don't have the attention span to slam a straddle and then not look at it again. I was looking to see what it's actually priced at. maybe it's only like maybe it's like $50, and I just made a really stupid. I didn't realize it was so cheap.
As a test. I'll do it my way. You do it your way. Let's see who makes money.
If we include commissions, then I might have a chance on here.
That's true. It's true.
I don't know why it's not loading up for me. I have to see what that straddle's pricing at. That's too funny. Yeah, and the other part of the sell off, there's a bunch of comments in here about various windows opening and closing from other people, and what I would just say is that it's much easier, I think, for volatility to materially increase after we've had a significant rally, and maybe one of the things here to sort of take away from the market is that we had a significant rally in the market as a whole, but we've really done a good job of kind of consolidating these gains. And we've spent a lot of time talking about this August analogy in which there was a significant rally to start August, almost of a similar magnitude to what we have now. I mean, this rally from kind of August 1st to, it's about 4 or 5%. And we're roughly about there now. If you look at what the February rally is, sorry, there's so many lines on the screen again. But what the point is that the market rallied very sharply here, right? And then we faded a little bit into August OPEX, but this was a consolidation and we started to rally again. And then this is when Powell came out and said, y'all don't get it. Like, we're really going to clamp down on things.
Jackson Hole, right?
Yeah, that was Jackson Hole. And, he took a sledgehammer to the market. And so this is the type of thing, well, like, yeah, what's the catalyst? If we get like Powell shifting his narrative, then of course, we can drop materially lower. But if anything, he's been fairly dovish over the last,
Well, yeah. I mean, I don't know if he's been dovish, but the market's taking him as dovish, right? Whatever the hell he says, market seems to love it. Market seems to react on other Fed speakers who are hawkish. But with Powell, he's just never hawkish enough for the market, and the market rallies every time he speaks at the moment, right?
Yeah. And that's also a sign, right? I mean, if you're sort of, sorry, I'm just looking up this straddle pricing here. I think that in and of itself is a signal. Like, people are less concerned about the data points. Powell's getting the benefit of the doubt on these various things. Vol just seems to be coming out. I mean, again, here's the VIX term structure for yesterday versus today. This is coming down. You see a similar thing in the S&P, and so these data points are not changing the narrative. Powell's not changing the narrative. I think if he's determined to make sure the market knows that the put is no longer in place or whatever it may be, like, he can get his point across if that's really what he's going for, right? But to your point, it hasn't. The market is not terribly concerned with that. With rate acceleration here, and it's not obvious that we're going to get a recession either. All right, so what's your bet without looking on the December 4150 straddle in the S&P? This is the regular December
4150 straddle.
I'm putting you really on the spot.
All right. Let me
I'm just going to tell you what it is. I don't. That's kind of a jerk move, but it is $575.
Okay. Yeah, it's about 12%, right?
Yeah. So the question is, do you want to sell me that straddle?
A bit more than 12%.
You want to sell that straddle or buy it?
$575, yeah?
Yeah. So, Corey Bell here. Thank you, Corey. Corey did it for us a minute ago. I missed it. 4,100 straddles done, 590. So yeah. So the official number here, $575 for the 4,150 straddle.
Okay. So your break even's like what, 47.25 and 3,600 or something, or right ish. Yeah.
Yep.
Yeah, it doesn't sound like a buy, does it?
It doesn't. I mean,
I don't think it does really sound like a buy. If you gun to your head, if you had to trade it long or short, you'd probably sell it.
I think sell it. So I'm going to go on record here as saying that I'm going to sell this thing. Please don't take my advice on this. And I do think that it provides some interesting opportunities to hedge around it. But I've really warmed a lot to this idea that this could be just a year where, yes, we'll get intraday swings and things like that. But, is this just sort of fair value where we've been more or less over the last 6 months, almost a year now, right? Yeah, we've had some peaks and troughs, but really, you can almost draw a line through 4,000, which is, again, this giant option strike, and not a whole lot has really happened over the last year, despite a lot of discussion. So there's your 575 points that will take you to 4,700 in the S&P. That'll be quite a rally to 4,700 in the S&P, and then to the downside, you're at 3,600. So I'm not sure we break that range.
Yeah.
Yeah. So we'll have to make this into a little clip so we can play it at the December OPEX and see what the results are. But yeah, I'm liking that idea. I gotta see about that. So last question here, Menachem, would you look to cover the straddle if VIX does indeed make it into the mid-teens? That's kind of an interesting. I don't know what the decay of that is. I don't know how much
It'll be a slow
that is.
theta run, but you'll have a bit of vega on it. It really depends if the VIX curve moves in a parallel fashion or not.
Yeah.
Because the VIX curve, if the front goes to 16, the front of the curve will get hit. That doesn't mean deck vol is going to get hit that hard. So it kind of depends, right? But yeah, it's one of those things like if they really smash the deck vol down hard, another like 4 vols from here, you probably would cover it, right? But
yeah,
you know,
yeah, that is kind of an interesting point, and it's a great point if we do think that vol is going to come down. If realized vol starts to come into the, and I got a screenshot of that, but if realized vol starts to really make, new lows, so to speak, which it very well could here. I think this is shorter term, 10-day realized vol. We've been unable to really breach this 15 area on the longer term readings, like 20-day. But this feels like it could. This feels like now these new lows are certainly in sight. I think over these next couple of days, certainly as we churn through OPEX, I think OPEX will serve to keep volatility a little bit lower. But again, what's the reason to really spike significantly lower on this market? And then also, even if we move lower, is volatility going to move materially higher? That also at this moment is not necessarily clear unless there's an obvious catalyst like a Fed change or some kind of geopolitical escalation. So, yeah, it's a great point to bring up, that shortfall kicker there on the.
I think the thing to watch out for is, like last year, skew was flattening, right?
Mm-hmm.
And when the market went down, vol couldn't catch a bid.
That's right.
Because no one needed to buy puts, right? Because no one owned the market. Now this year, we've started to see the first signs of people buying the market, like January, taking the market out, skew then catching a bid at the first sign of trouble, right? And some protection buying coming in, right? Like for big events like the CPI. So what you need to do is you need to see skew work its way back towards mid percentiles. Right now it's in the 20th percentile. Last year it was at the lows. It needs to continue to reprice higher to reflect the fact that actually the street owns the market. The investor base is exposed to the market. They've bought a load of downside from dealers, and dealers are short down there,
right?
Materially short down there,
right?
Then you've got the firepower for a real material vol spike if something makes the market sell off, right? But until you have those conditions, I think it's unlikely.
And maybe to that point, then you actually need a continued equity market rally or some sort of signal that equity allocations have increased, and then you'll see more of that hedging flow along the lines of what we've seen in the last few weeks of those VIX calls and things like that. So, so that is a really good point, Imran, on that. All right, and as we approach the top, Cameron says, from an HTF perspective, would we describe this as a bull trap? I'm not entirely sure what it means on that one, but I don't necessarily think this is a bull trap here. Again, I think we can get some consolidation back to 4,000, but I would view that mainly as consolidation off of the back of OPEX. I just don't see a reason for the market to trade, a whole lot under that level again without a catalyst. So just kind of repeating what I've said a few times here. So, Imran, as we approach the top of the hour, how can people follow you and get a hold of you if they're interested?
Well, I'm pretty active on Twitter, as you know, options_insight. So come and check out what we're putting on there. We give a flavor of all our products on there and what we're up to. Otherwise, check out our website as well. There should be a link. Yep, there's a link, optionsinsight.com, directly to our website there on our Twitter as well. And we've also got a YouTube channel where we post daily videos, which again are from our subscriber content, giving you some insight into what's going on in markets to keep you up to date, basically.
Yeah, and we would be remiss if we didn't mention the SpotGamma Academy, and you are the featured face here on The Hedge, which is our 3-part options course. So this walks you through everything from what is an option all the way up to some of these advanced topics we've covered about, like volatility and hedging and and Vanna and Charm and all those other buzzwords. You can take them all as a bundle. You can take them separately if you'd like. But we partner with Imran on this because Imran actually does a lot of training for banks. So new guys that hit the derivatives desk at the banks, he had a great training program for them. And he said, look, this guy's got an incredible course. Why should we attempt to rewrite what's already so amazing? And so please check that out at academy.spotgamma.com and let us know what you think about this course for any of you that take that. So with that, Imran, I'm going to say thank you very much for showing up. The weeks go by so fast, man. It's like, I can't believe like we're already back to another OPEX. And so the next one's going to be March OPEX, which should prove to be a very large expiration, obviously, because it's the quarterlies. And and so there's going to be a lot of positions, I imagine, shifting in and around that time. So it's going to be quite an interesting one to watch.
I look forward to chatting to you then, mate.
Yeah, absolutely. And thank you all very much for taking the time to watch with us. Any comments or questions, please put them in the description in that comment section, and we'll make sure to get back to you. You can also reach us at SpotGamma.com, info@SpotGamma.com if you have any questions about SpotGamma or questions on any of the topics we brought up as well today. So with that, we'll be signing off and see y'all later. Take care.